Okay, today we are going to talk about market shifts. Market shifts are very, very important because if you are not able to identify market shifts, then you will not be able to identify when the market is changing its direction or continuing in one particular direction. Because that's exactly what we use market shifts for, is to understand the continuation of trends and understand the reversal of trends. Market shifts, they appear in every single time frame. It does not matter if we're talking on the daily, if we're talking on the 1 minute. You will be able to see market shifts. And one of the things to keep in mind is that the lower the time frame you go, the more of everything that we are going to talk about is going to be disrespected. Which means when you are on the 1 minute, there are multiple fair value gaps that will be disrespected. There are going to be multiple market shifts that didn't mean anything. There's going to be order blocks that are going to be disrespected. There are going to be the most amount of liquidity grabs that don't amount to anything. That's because the 1 minute, it moves a lot. And so you have to be very, very precise. That's why I recommend you going at least into the 5 minute, because you'll have 5 times less candles than on the 1 minute. And it's important because when we start trading and we start putting all the pieces together that I'm going to give you, you will think, okay, so now this is exactly what you're going to think. Give me a second. So our entry model is going to be wait for a high time frame PD array, wait for the market to go there, and then wait for the market shift and enter in line with the overall time frame, right? So this is going to be our, for example, fair value gap right here, and then we'll have the breakout and we'll have a pullback towards the fair value gap. You want to see the market shift, and the problem is that on the lower time frames, this is going to have one of these market shifts. This is going to have one market shift. This is going to have one market shift. So you would take -1, -1, -1 because you're never being able to call the low. Yet once we get to the high time frame key level, once you see a market shift on a good time frame such as the 15 minute, even the 1 hour, or let's even say the 5 minute, then you will be able to enter in this profitably. So let's go into the Miro board. And first, what do market shifts represent? Well, market shifts, as the name say, they present a shift in market structure. This can both be for reversals and continuations. Let's first start off by looking at reversals. Where do you think that this is the time frame of the daily? So you can see that the market is moving lower, moving lower, moving lower, moving lower, moves higher, moves lower, and then we have the market shift right there on the candle with what? A candle body right there closing above this previous candle body. That is what we recall the market shift. And then we can see the market moved towards the upside. Now, before we go lower, we can actually already see the next market shift. Let me ask you, where here do you see a continuation market shift? A market shift requires a pullback and then for the market to shift once again in that specific direction. Where do we see that? We see it right here, right? Candle closure above. This creates a new order block. We'll still talk about that. And then we move towards the upside. So that is for reversals. Reversals, this is the reversal market shift. And then when it comes to continuations, we have move higher, move lower, move higher, pulls back, moves higher. This is another market shift, continuation market shift, and then the market just moves higher. Right? So can you see how candle bodies are extremely, extremely important? So what do market shifts actually look like? Well, this is what we call a reversal market shift in both of these. We have market shifts when it comes to continuations. We have this here. These are continuation market shifts, but this is a reversal market shift. This big one that we have right here. Same thing here, continuation, continuation. Eventually this gets disrespected and we have the reversal market shift. Now, one of the things that is very, very important, and it's going to be one of the most important things when it comes to market shifts. Market shifts are only marked by candle bodies. The wicks do not matter. There's a saying that goes, wicks, bodies tell the story, wicks do the damage. What that means is that the market might go down 5% in 30 seconds. If the market still completely reverses and closes above a fair value gap or above an order block, that order block and fair value gap are still respected. In this strategy, the most important thing is candle bodies. We do not care about wicks because wicks are mostly liquidity grabs. You want to see a market shift closing above the previous candles. So for example, you can see it right here. This is not a market shift because there was no candle body close above this down move. Same thing right here. You do not have a body candle close above this down move. But in this situation, and I put it in 2 because this could be even 3 candles. Like if the next candle closes like this, then now we have a market shift. But for now, we do not have a market shift as of yet. Then, last but not least, we have the market shifts where we have the move lower, followed by this reversal, candle body close above the down move. Therefore, this is a market shift, right? And then also here, this is a market shift. Doesn't matter if it's 1, doesn't matter if it's 2, doesn't matter if it's 50. Obviously, if it's 50, if it takes 50 candles for the market to reverse a move, then maybe it's not that strong. But 1 and 2, I wanted to have 1 and 2 to actually give you a perspective on this is how it looks, right? So also, another thing to keep in mind, the down move is the first bearish candle. In this case, it's the first bearish candle after the last bullish candle. So you can see that we had right here a reversal. Therefore, the bodies of the candles that are going to mark this high are what we are going to class as the market shift barrier. If the market closes above, then that is the market shift. If the market does not close above, then that is not a market shift because it can easily just be a liquidity grab to continue moving lower, right? And then what you will see is something like this, where the market moves lower, boom, and then you have the nice move that takes you to the upside. So be very, very careful with wicks body closures. So now, continuations and reversals, you can see it right here, very, very clear. But first, again, this is just an idea for you to understand how we are going to approach market shifts in the market. We'll go into the charts very, very soon, but it's important for you to understand that this is going to be a key part of our entry strategy. Why? Because this would be an entry of ours, right? This right here is an entry. If the market would have pulled back and moved higher, this would have been another entry. In this case, we did not pull back, just a tiny, tiny bit, right? So with that being said, market shifts are going to be extremely important because they are going to give us the sense of direction and they are going to give us a sense of if the market is continuing to move up or if it's actually reversing. So for example, if I tell you right now, okay, look at this price action. Where do you think the market is going to go next? Would any of you say, oh yeah, you know what? I think the market is actually going to move bearish. No, none of you would say that the market is moving bearish here after this candle, specifically this candle prints. So can you see how market shifts, they tell you such a big story behind where the market is going. That's why the continuations and the reversals are very important when it comes to market shifts. So right here, where's the market going to go next? Is it going to go towards this low or is it going higher? Well, as soon as we have this move, you know the market is going for this high. Then we sweep the high, we move lower. Once we close, you are very, very confident that the market is going to move to the upside. And so it did. You can see this move to the upside, right? So it's all about understanding what market shifts tell us. Same thing here. Once we start seeing this slow down and then we have this shift, you are like, okay, the market respected this inverted fair value gap. That's first of all, we'll talk about it. The market has respected this fair value gap. Therefore, I expect the market to move a little bit higher. And I'm not saying that the market will fully reverse. We will not say that the market is going to fully reverse, but we're saying that the market is very likely to come towards this high and this order block, which we are going to talk about in the targets section, which are going to be the magnets in price right here. So you would expect the market to move from order block towards those targets. And then what happened? The market, let's completely delete this, else I will go crazy. The market moved to that target, rejected, next target, rejected, then moves lower, market shift. What is the next target? It's going to be this high. What is the next target? Then it's this high. So can you see how it's always a dance between market shifts, reversals, and continuations? But the most important for you to understand really is the continuations market shifts. Those are going to be the most important because I don't want you to try to catch reversals. Reversals are very hard to catch. You can still do it, and we will do it. This was one of my biggest trades last year where I entered in a long right here, and then this ended up resulting in an 8R total. So very, very nice trade. But overall, continuation market shifts, those are going to be the easiest ones, but these are going to give you a sense of direction in the market. You ask yourself, what is the direction of the market shifts? Where is the market heading? What is the next target? This is all going to be through market shifts. So quickly, let's go onto the charts and see that exact same thing in order. So you can see that the market right here on this move to the upside, the market is obviously shifting to the upside, moves lower, shifts up. So it's obvious that this is going to be the next target. Why? Because every time that we get a reversal, a tiny reversal, it gets quickly bought up. And you see that confirmation through the market close. But then notice how we have move lower, move higher, move lower. So now we've had an internal market shift right here. Therefore, now we are looking for bearish targets, which are going to be this low, which we then end up targeting. Then we have the reversal. So this is now a very good bullish market shift going with external structure. And we'll see that and you can see that in internal and external structure, the whole lesson on market structure. Then we have this reversal right here. With this is a market shift, a bullish market shift. So now you're only looking for longs until something like this starts happening, when we start internally shifting bearish. We move higher and then we react from the volume imbalance and we start moving to the upside. So market shift. So after this specific day, what is the target? Well, we just had a bullish market shift. Therefore, our next target is going to be this high right here. Now, let's quickly go onto the lower time frames and see how we can apply market shifts when it comes to entries. So here's one of the examples of where we can see market shifts taking over. We can see that overall the market is going quite bearish. We had a very big news catalyst that ended up pushing the price lower. And then eventually what starts happening is that the market is ranging, but notice where the last market shift was heading. The last market shift was bearish. Therefore, we have a very big bearish order flow and the market continues bearish, shifts once again. Then the market continues bearish, shifts once again. We have a bullish shift, yes, but that gets completely mitigated. And by the way, this is a 15-minute chart. So once again, a lot of people that try to call the lows, they get caught in this sort of market shifts, not understanding that a good market shift, it's continued. It's not just one simple market shift. It's a market shift that happens once, happens again, and there you go. And we can see that. We can actually see that right here where we move lower, right? Very big move lower. This is like a liquidation event. Just like here, this is a liquidation event. The market moves lower, shifts bullish. The market moves lower, retraces, right? And then, yes, we start moving a little bit lower, but then, boom, we move bullish. Okay, this is an internal market shift. And now you're like, okay, interesting. So are we going to the lows again? Maybe the overall structure is still bearish. Move lower, higher, lower, right? The overall structure is still bearish. So you're like, okay, interesting. We had the first market shift. Notice we also had it here. Then we start moving lower. And then you think, okay, maybe we are going to go to the downside. You don't enter in any trades yet. This is range bound price action, and you don't want to enter there. And we shift bullish again, and you're like, oh wait, this is actually telling us a lot, because now we had one bullish market shift. We tried to go lower, another bullish market shift. So the bulls are taking place, right? A bullish internal trend at least is taking place. Because you see one internal market shift, second internal market shift. So notice how the market shift is showing you so much the sentiment in the market. right? It tells you so much. It's insane. And so we have 1, 2. At this point, you're like, oh, okay, I'm not bearish until when? Until the market shifts back to bearish. Then we would be bearish. Okay. But right here, you can start seeing moves higher, and then boom, we move higher again. And this is where like, okay, we're bullish. And notice how quickly, after confirming that the market is bullish, the market then moves to the upside. We're talking in 2 hours, the market moved 55 pips. That is a lot, right? And we saw that after the liquidation event, and we started to see multiple market shifts in our direction. So once again, liquidation event, market shifts bearish. Okay, we are still bearish. Then market shifts again. We are still bearish. We see one market shift. We're like, okay, interesting. But we shift back to bearish. Okay, we're still bearish. Market moves higher. We start moving lower. We are still bearish. Oh, okay, interesting. We had the first market shift bullish. Okay. Let me stay in the sidelines a little bit. Market moves lower, tries to go for the low, shifts bullish again. Okay, we had now 2 bullish market shifts. 2. The structure is starting to change. Therefore, I am not that interested in shorts anymore. And if you want to be aggressive, this is where you would enter. If you want to be more passive, this is where you would enter. And in both, you would have had a very nice trade. And then notice, we have this market moving up, moves lower. Notice, we have no market shifts bearish. Market moves higher, moves lower, is not able to close the low. What happens after? We move higher. Boom, moves higher. And then we move higher yet again. And then we shift bearish, but that's the first one. And then we shift back to bullish. This is where you would enter. And then the market moves very, very quickly to your final target. Once again, you see this. Market moves higher, moves lower, moves higher, moves lower. All of the lows are getting bought up. You can see these market shifts happening, and then the highs are targeted, right? So market ranges, it's still bullish market structure, then shifts bullish, moves back down, shifts bullish, and then we have the final move up. So can you see how we were able to have a sense of direction from the market through seeing how the market shifts are working? And let me tell you, because I actually traded this, and when you have the overall idea of market structure, daily bias, targets, you'll see how all of these things piece together, and they give you such a valuable edge that allows you to understand how to make this work long term. Therefore, like there was actually a sweep of a low right here, so you would already be thinking, okay, I don't think the market is moving much lower. So once you start seeing the bullish order flow, you're like, oh, interesting. So then you would be able to be more aggressive, and therefore you would be able to enter in this long, right? So can you understand how having all of this and then having the high time frame structure and liquidity sweeps and so on to help you, it's going to help you so much. And we're going to target all of that in this bootcamp, believe me. Now, I want to talk about in terms of targets, because targets are very, very important. So let's see. Let's go back here. So we start to see that the market is approaching an extreme, right? At the extreme, you start believing that there's a possibility that the market starts retracing, even if it's just a little bit. So afterwards, we start having this bullish market shift, right? So now we have what? We have one market shift, but that market shift is accompanied. It has a different market shift right after. So we have 1, 2. Okay, this is where your eyes must be like, oh, okay, maybe there is something in the longs here. And then if you want to be more conservative, if you want to be aggressive, this is where you would enter in the longs. If you want to be more conservative, this is where you enter now. Because now we've had the confirmation, because not only do you have 1, 2, you have 3 market shifts. So this is where it shows you the direction, and now you start looking for targets. It's like, okay, so now, and we'll talk about this in the target section. Because we're bullish, these are all of my targets. This high, so on and so forth. Let's see. Market reaches both of those highs, reaches the next high. What is your next target? The next target is going to be this order block, and then it's going to be the extreme up here, and then it's going to be the high. Let's see if we reach all of those or not. So the market moves higher, reaches that, comes to the fair value gap, moves higher, reaches the next target, and then starts to break lower. Now, this is your first market shift, right? Do we fall for the first market shift? No, we wait for confirmation. So the market moves higher. Okay, this is your second market shift. And then, there you go. We have a constant respect of the fair value gap. This is where the higher time frame fair value gaps and everything is going to help. All of this is going to be broken down in the fair value gap section. We move bullish again. Notice, very nice market shift in line with the overall external structure right here, followed by the continuation to the upside. So now, what do we have? Boom, we reach all of these highs, right? So can you see how we notice where the market is starting to move lower? So we have bearish market shift, bearish market shift. Okay, maybe the market is a little bit bearish, retraces back to the order block, moves lower. Once it sweeps the low, moves higher, this is where you turn bullish again because you have the bullish market shift in line with the external structure, and that's where you have the high probability trades. It's when you enter aggressively on these days where we have the confirmation that the market is moving to our targets. So with that being said, this is how we are going to be using market shifts. I hope you enjoyed, and let's go to the next one. See ya. Hope you enjoyed this lesson. Click right here to watch the next one. And if you are struggling with overtrading, then click right here to check out Trade Blocker. Peace.